If you only have $100 and a full-time job, you need to swing trade. But you can't just guess. You need a mechanical system. This is my complete swing trading strategy, and it does exactly three things. It uses two specific moving averages to trap price inside a high-probability pullback zone. It gives you a yes or no entry trigger using one exact pattern, and it uses a mechanical exit framework that locks in profit early. Look at what happens when you combine these three things. This is a 3-hour trade on gold, caught with zero emotion, using the exact rules you are about to learn. This is how the engine works. You buy pullbacks inside uptrends, and you short pullbacks inside downtrends. That is the entire swing trading game. Price climbs, dips, climbs, then dips again. Each of those dips inside the climb is your entry window. Now flip it. Price drops, bounces into the trend, drops, bounces again. Every bounce is a short window. Markets spend roughly half their time trending or pulling back inside trends. We will use the daily time frame only. This is non-negotiable. Lower charts are noise factories that punish small accounts with fees and bad fills. The daily forces patience. You look for the setup after dinner or in the morning. You make one call and you close the laptop. That's the whole frame. Now, defining the swing trading game handles the what. It does not tell you which charts qualify, which is the only thing that matters next. You need two exponential moving averages. Find them in TradingView. Set period 20 on the first one, period 50 on the second. Both close, both daily. Why these two? The 20 tracks short-term momentum, the level swing traders are reacting to today. The 50 tracks longer-term institutional drift. When both agree, real money agrees. When they disagree, you have noise pretending to be a trend. 3 checks, in this exact order: alignment, slope, and price position. The 20 must sit above the 50 for longs, below for shorts. Both moving averages must point in the same direction, and price has to be on the right side of both, above for longs, below for shorts. Look at this. The 20 sits above the 50, both lines pointing up at a clean angle. Price stacked on top of both. That's a tradable uptrend. Now mirror it. The 20 sits below the 50, both pointing down. Price below both. Tradable downtrend. Now look at this one. The lines are tangled together, crossing back and forth. No clear order. You close the chart when you see this. And this one. The lines are aligned but flat. No slope. Price just drifting sideways. Again, close the chart. You have no reason to trade. Remember this. Moving averages don't fail in trends. They fail in chop. The slope filter alone kills roughly 50% of the garbage setups before you even look for an entry trigger. That is why this filter exists, to stop you taking trades that were never going to work in the first place. So hard rule, if the EMAs are aligned and sloping clean, you have a tradable context. If lines are tangled, flat, or crossing, skip the chart and don't reopen it that day. The trend filter is the easy half. The next layer is what turns a trending chart into an actual setup. A trend alone is not enough. If you buy after price has already moved far above the 2 lines, you are late. You need price to come back into value. That is what the pullback gives you. In an uptrend, a pullback happens when early buyers take profit, short-term traders get scared, and price drifts back down. But if the trend is still healthy, stronger buyers often use that weakness to enter. So we need a pullback zone, not a random area, a defined zone. For our setup, the pullback zone is the area between the 20 and the 50. That is where price must pull back before we even care about an entry. Why a zone, you might ask? Because price rarely respects one perfect line. Sometimes it touches the 20 line and reacts. Sometimes it pushes deeper toward the 50. Sometimes it trades between both for a few candles before continuing. If you use one exact line, you will miss good trades and force bad ones. A zone matches how markets actually move. Look at this. Price is in an uptrend. The 20 line is above the 51. Price pulls back into the space between them. That is the zone. Now the chart has our attention. Now here, same thing. Clean downtrend. Pull back into the zone. Price is not to extend it anymore. This is where we start looking for a short trigger. If price closes beyond the 50 EMA on a daily candle, the setup is dead. No entry, no second chance, no waiting for it to come back. Move to the next chart. So binary rule, price inside the band with the trend intact. Setup is alive. Price closed beyond the 50. Setup is dead. Okay, trend is intact. Price is in the zone. Now we wait for one specific signal, and only one. The entry trigger is the outside bar. An outside bar is a candle whose full body covers the full body of the candle before it. It must dominate the body of the prior candle. In an uptrend pullback, you want the outside bar to close bullish. That means it closes in the direction of the trend. In a downtrend pullback, you want it to close bearish. Again, in the direction of the trend. This candle matters because it shows a shift in control. That tells you the pullback may be ending. Pay attention here. Trend is up. Price pulls into the zone. This candle breaks the high and low of the previous candle and closes green. Valid outside bar. Now this one. Downtrend. Price pulls back into the zone. The candle breaks above and below the previous candle and closes red. Valid short trigger. Now look at this third chart. This is an outside bar, but it forms far above the pullback zone. It is tempting, but you skip this. The candle is valid, but the location is wrong, and the setup needs both. Now look at this one. This candle looks strong, but it does not break both the previous high and the previous low, so it is not an outside bar. You skip this too. The outside bar is the market telling you the pullback has resolved. You do not enter before it forms. Entry is always on the close of the outside bar. You wait for the daily candle to close. If the candle meets the rule, you enter. If it does not, you do nothing. Okay, now you are in the trade. Most swing trading guides end here. But this is actually where the work begins, because where you exit determines whether this system makes money. You're in a long trade, right here, after all conditions were met. The stop goes just beyond the opposite extreme of the outside bar. This candle defines your entry, and it also defines your risk. If price breaks the opposite side of that candle, the trigger failed. Now we use the 3-tier exit. Tier 1 is the 1R. Once price moves in your favor by the same distance as your risk, you take off 50% of the position. This is mechanical, and the reason is simple. Small accounts need emotional protection. When you take 50% off at 1R, you lock in a real win early. Tier 2 is the break-even shift. After 1R is hit, move the stop on the remaining 50% to your entry price. Now the trade can no longer lose money. The worst case is that the second half comes back and stops at break-even. Third tier is the trailing stop. We trail it using swing structure. For a long trade, trail the stop under the most recent swing low. For a short, above the most recent swing high, and only update it after confirmed daily candle closes, not during the candle. This keeps you in the move until structure actually breaks. Look here, price is in an uptrend and it pulls into the 20 and 50 zone. A bullish outside bar forms. Entry is on the close. The stop goes under the outside bar low. After price moves one risk unit in profit, we take 50% off. Then the stop on the rest moves to break even. After that, as price continues higher, we trail under each confirmed swing low. This exit is asymmetric on purpose. Tier 1 creates a high feel-good rate. Tier 2 removes downside. Tier 3 gives the trade a chance to become large. Most traders only do one of these. You're different. Now, imagine it is Monday morning. You have a full-time job. You do not have 3 hours. You have 20 minutes. So you open your watch list and run the same process on every chart: trend, zone, trigger, and action. SPY daily. The moving averages are tangled, flat for the last 3 weeks, with no slope. Trend test fails on check 2. You close the chart. Euro-dollar daily, 20 above 50, both sloping up clean, and price riding well above both. Trend confirmed, but price is extended way above the 20, nowhere near the zone. No pullback yet, so no setup. You keep this one on the watch list for next days. Then NAS daily, strong downtrend. The two lines aligned and sloping down. Price has bounced up and is sitting right inside the band between the 20 and 50. Yesterday's candle is a small red candle, but no outside bar. This one goes on the watch list. Now gold, uptrend is confirmed. Alignment is clean. Price dropped right into the zone, and yesterday's candle closed a bullish outside bar. This is the trade. Stop one tick below the outside bar low. First partial alert set at 1R. Break-even order ready at that level. 3 out of 4 charts produced no action. That is the goal. Most days you do nothing. Boredom is the price you pay to grow your small account. Most charts get rejected. Some go to the watch list, and only a few trigger. Some winners run. Some valid trades still lose. This is what trading actually looks like. But if you want to bulletproof your entries, the next layer is adding key levels, support and resistance. This single filter is the difference between a 50% and a 65% win rate on the exact same setups. That's the next video, and this is exactly the kind of setup we break down inside our academy. See you inside.